Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the February investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weisse, about what's going on in the markets and the investment universe right now that we think you need to know. Bob, welcome back to Wealthy Behavior. How have you been?
Thank you, Sammy. Been well.
Yeah, it's hard to believe we're already into February. What is on your mind in terms of educating our listeners this month?
Well, as we're recording, there's a Fed meeting today, so it's back to Fed Watch, and 2024 is going to be an interesting year on that front. We've been through really a cycle of fighting inflation, increasing rates, and 2024 is expected to be the year where they cut rates and cut rates a number of times, and that's kind of the big question: when do they start cutting, and how much by year end? So. At this meeting that's happening today, expectations are for nothing, but we'll probably get some guidance, whether it's through the meeting notes or the press conference. So it'll be interesting to see, what they do as we progress through the year.
So we've talked about this before, Bob, but why would they cut rates if the economy is doing well? What would be the urgency there to maybe add juice and perhaps re-stimulate the economy or trigger maybe more animal spirits and inflation?
Yeah, it's a good question, and that's what they're wrestling with. So I think there's two things to think about in answering that. One is there's different levels of the Fed funds rate where it can still be restrictive. So right now we're in the 5.25 to 5.5 range. So that is, you could call it restrictive. It's above average, so foot's on the brake. If they cut it, say 25 basis points to 5 to 5.25, that's still restrictive. So it's just like how hard do you want to be pushing on the brake. So when inflation's 9%, you should be pushing the brake a little harder than when it's 3 to 3.5. So you can still be restrictive. It's not like drop it down to zero again, like it was a few years ago. So that's on one hand, just lighten it a little bit, but still in the restrictive territory. And then the second point on that front that we've talked about is the lagging effects of tight monetary policy. How you increase rates, and by the time the data is released, there's a delay. So it's they don't want to get caught with whoops, there's a recession, and now we start cutting rates.
So basically, you're saying flip the framing. It isn't why would you cut rates if the economy's fine. It's why would you keep them so restrictive if inflation's improving? There's some lag in the data, and keeping them this restrictive could cause problems down the road. So start to ease off a little bit.
Yeah, and so the Fed has a dual mandate, employment and inflation. And at its worst, you could say inflation was 9% and unemployment was at about a 40-year low. And it's ticked up a little bit. The labor market, unemployment's ticked up a little bit from where it was. And the JOLTS report that we talk about, job openings per unemployed individual was about 2 to 2.1 at its peak, where there are 2.1 jobs. That's a very too strong labor market, they would say. There's not balance in the labor market at that level. That 2.1 ratio is down to about 1.4.
Okay.
So on the labor side, they've seen some softening. It's almost back to the average level there. And then inflation's come down. So should they have the same policy in today's environment that's a little more balanced, still a little hot on the inflation side, as they did when it was so out of whack when inflation was at 9%. So I think that's part of it.
And how do markets react, Bob, generally to rate cuts, or is there not a general expectation of how markets react?
Well, you see it most in the bond market. That's where it gets priced in, and markets try to anticipate it.
Okay.
So if the Fed telegraphs it, it gets all priced in, and sometimes it's truly a non-event for at least intermediate and long-term bonds because it gets priced in well in advance. What we've seen And this month, January is a good example. So in January, the Bloomberg aggregate US bond index, the total returns about negative 85 basis points. So bonds are down almost 1% in January. And why is that? The market's been adjusting. In December, the thinking was, okay, they're going to, I think there's a 50-50 or even higher chance of cutting by March of 2024. And some data has come out in January that have made market participants think, yeah, maybe not so much. So maybe March will be a pass as well. So the market's adjusted to that. So the market's kind of guessing what the Fed's going to do. So frequently you'll see the market action before the news.
And so you wanted to touch on today what has been going on in the bond market. So that was essentially what you wanted to point out in reaction to some of the Fed expectation and rate moves that we've been anticipating.
I mean, to be a little more concrete with it, so CPI for December came in at 30 basis points of inflation for the month, year over year 3.4%, which is still a little high, like 0.3 for a month. That's we had been coming in around like 0 to 0.2 for the last couple of months. So it was a little elevated, and that I think is one of the main drivers. PCE was 0.2, 2.6 year over year. So just having that type of data is what the market said, along with seeing strong GDP growth, made the market say, you know what, maybe they won't be cutting as quickly as we thought. And that's how you've had a little bit of a sell-off in bonds. On the equity side, U.S. equities have been volatile, but recently have run up and been pretty strong there, led by large growth. And so U.S. equities are up a couple percent in January. And overseas markets are a little more mixed, with there being a sell-off in emerging markets down about 3%. There's been some volatility there, especially with China, has been really tough over really the last about 3 years. I think China peaked in around early 2021, and that market's down close to 50% since then. So if you want to be a contrarian and go where the valuations are really cheap, that's China right now.
And so just sticking back to the Fed and the potential for cuts, and you outlined the impact on the bond market. We didn't talk specifically about what stocks would do. I want to get to that in a second, but there is, I think, one area that, and we've talked about it before on the podcast, where there is a direct impact and it is actionable for investors, and that's with short-term bonds and money market yields, right? I mean, there should be a direct hit to those yields when the Fed cuts rates, and that is money that people, if it is mid to long-term money, should be redeploying, even though we've been telling them that for a while.
Yeah, that's exactly right. The T-bills, money market yields, that moves with Fed policy pretty much in lockstep. And when they start cutting, we don't know. But looking at like the CME FedWatch tool, meeting probabilities, there is a 0% chance priced into markets that rates stay where they are by the end of the year.
Okay.
The average right now, the break even is around four to 4.25 Fed funds rate. So like a 125. Like 5 rate cuts.
Move downwards, yeah.
Yeah, and so whether they cut down to 4, or cut to 4.25, or 3.75, like that's what the market's expecting by year end. With it looking right now that around the May meeting is above a 50% chance that they're going to start cutting. So the money market yields you're getting now, it's highly unlikely they'll still be there at year end.
You said 50% chance by May. I think the market had been anticipating March, right? Which is
Exactly.
something you had chatted about. Okay. So from a financial planning standpoint, if you have variable rate loans, they may be cheaper to you by year end if
Yes.
what you just laid out actually happens. Could be 1% to 1.5% less than what they are right now, which would be nice benefit to consumers and the economy.
That's right.
So, touching on stocks real quick, Bob, there's, I think, a view that stocks do very well when there's an easy monetary policy and the Fed is cutting. Would you say, the incremental moves that we've talked about would fit into that tailwind for the market, or has the market already kind of priced in where we could be going this year, and that's why we had such a strong end to 2023?
No, I mean, there's the old Wall Street adage, don't fight the Fed. And I think there definitely is something to that. And if the Fed is getting more accommodative by cutting the Fed funds rate, that probably is a good thing for markets. And it's just kind of cross your fingers and hope that they're not doing it in the eye of a recession around the corner. But if they pull this off and cut rates this year and a recession doesn't come, that's a good outlook for stocks, good environment for stocks.
And Bob, any thoughts on the Fed's balance sheet? Have they been unwinding that as well?
They have been, so that's also it's definitely gets less media attention. Back in 2020 and 2021, they were doing what's called quantitative easing, where they were buying bonds and buying mortgages, and that's their way of impacting intermediate and longer term rates on treasuries and mortgages. And they have been reversing that, where they've been unwinding a little bit.
So before we jump to another topic, Bob, I just want to get maybe reflective on how we're doing as, podcast hosts on this monthly conversation. We've spent a lot of time since this Wealthy Behavior podcast launched talking about the Fed, talking about rates. Have we overdone it? And is this really, kind of the most important topic for investors over the last year? And at some point, would we anticipate talking less about the Fed?
Answering backwards, yes, at some point we should talk less about the Fed, but I don't think we've overdone it. We went a decade with inflation right around 1 to 2%, and then it spiked up to 9, and the Fed, got very aggressive raising rates, and it's I think definitely been the story of markets, and seeing how they make it through this year will be critical, and then maybe we'll be back to more normal environments, and we can talk about whatever else
there is to talk about. Yeah. All right, good. I'm going to pat myself on the back that we're asking and talking about the right things and that you've reassured me. So moving away from the Fed, I know you wanted to talk about something that I don't think we've addressed really on the podcast before, which is an investing / financial planning concept, asset location, where to position your investments in order to reduce your tax bill.
Yeah.
Basically.
So we've recently been doing some portfolio rebalancing, and we're also in the process of reviewing client 529 plans and our 529 plan models. And I thought tying that all together on the asset location topic would be interesting. So there's asset allocation that most people are familiar with, like how much to allocate to stocks, to bonds, to real estate, etc. Asset location is once you have a good sense of what you want your asset allocation to be and what positions. Asset location is what account structures do you locate those assets? And there's 3 general account types: taxable, tax deferred, and tax exempt. So taxable, think a individual brokerage account, joint account, trust account. Tax deferred means you're deferring the tax liability. It is coming, but it's deferred. So that's a 401k or a traditional IRA. And tax exempt is a Roth IRA, and also like a 529 plan or healthcare savings account can fit in the tax exempt bucket. So you have 3 different account types by the tax code. So when you're building a portfolio, what we do is we put the assets that we expect to be the highest returning in the tax exempt bucket. So the Roth IRA, so if we think there's, say, a stock allocation that's going to return 10 to 12% a year, you want to put that in the tax exempt bucket, because that money you'll never pay taxes on. You're not going to pay taxes year to year as it grows. You're not going to pay taxes when the money comes out. So you want to make the most of that. And then for the tax deferred bucket, where you're deferring it, that's the bucket where fixed income typically fits the best. So if you have taxable bonds, you put the bonds in there. And by deferring it, you're not paying taxes on the interest payments, the coupons that you collect year to year, but you're also not growing it too fast, because if you grow that one at, say, 12% a year, then when you take it out, you're going to have a big ordinary income tax bill. So if you have more conservative assets, typically you put them in the tax deferred. And then on the taxable account, that's where equities typically are a good fit, because they're taxed more favorably with long-term capital gain rates. And it's more at your decision when you sell, when you incur the gains, so you can defer taxes there. So I know that was fast and a lot. If I can segue to 529 plans, which can play an interesting role. But that's it at a high level. Just we see when we look at portfolios for new clients, most people look at each account on its own and don't integrate the accounts around tax structure. And I just think it's an opportunity to improve many portfolios.
So how does that play out, Bob, in an environment where, for example, bond yields were anemic for a period of time? Would you interchange the bonds with the stocks? Would you reassess your asset location, I guess, priorities? How often do you revisit that based on your return expectations for the different asset classes and what's going on in the environment?
Yeah, so if you think about it, I led with first deciding what you want your asset allocation to be. So if you say I'm a 60-40 investor, 60% stock, 40% bond, that's the right level of risk for me. That type of portfolio might have a 10 to 15% drawdown in a stressed environment, and that's my level of risk, 60-40. And then let's say you allocate and you happen, for this simple analogy, to have 60% of your wealth is taxed,
Yeah.
40% is in your IRA. So your IRA is all bonds and your taxable account's all stock. Then we play out an anemic bond environment. What happened? Your IRA didn't really grow and your taxable account grew a lot. Stocks did well. That's a good thing. That's a good outcome for the 60-40. I'd rather my taxable money to grow faster because that's free and clear from taxes. You own it, and you get all the upside other than the capital gains. Whereas the IRA, the government's kind of hanging over your back, and they're going to take their call it 1/3 slice whenever you withdraw. So that one didn't grow because bond yields were anemic, and but the taxable account did grow the most. If you were to flip it, and your taxable money has the anemic return, and meanwhile the tax deferred grows the most with the equities, then at some point the government's going to take their big bite out of it. So it works very well with an anemic environment in bond yields like that. And then if you flip it to higher yields in fixed income, if you put that fixed income in your taxable account, that's going to be a pretty hefty ordinary income headwind for you.
Yep.
So really, either way, bonds are a nice fit in the tax deferred account.
And how do you deal with wild cards, or I guess not a wild card, but a variable like a municipal bond, where, the yield could be attractive, but it's tax free, but it's sometimes not attractive on an after tax equivalent basis? How do munis fit into this?
Yeah, that definitely brings some complexity. So we look at the break even at the individual level. So look at your tax bracket, Fed and state, and what it would be if you own taxable bonds versus municipal bonds. And if munis work, typically we like to have an allocation to munis, but not have it be the entire fixed income allocation. And a reason for that is the municipal bond market has less liquidity than especially the treasury market. So what you see in periods of panic, call it like a March of 2020, or certainly the financial crisis of 2008, people are buying treasury bonds. So if you own treasuries, it's appreciating, the price is going up, and people are basically selling everything else, including munis. So municipal bond prices are going down. So munis are they're bonds, but even investment grade, like a AA rated muni, those can suffer from a lack of liquidity in markets when you want your bonds to hold up.
Okay.
So you just have to be careful with, like we might allocate 25 to 50% of someone's fixed income to munis, but typically not go too much higher than that, because the treasuries and high quality corporates and agencies, things like that, tend to have more liquidity and therefore hold up better. And when you think about it, why I say more liquidity, it's because the market participants, it's just a deeper pool of investors. So who buys munis? U.S. individual taxable investors. So tax exempt institutions like, pensions and endowments aren't buying munis. Foreign investors aren't buying munis. So you don't have as much depth. So when retail investors get a little skittish, the municipal market can be in trouble.
Even through commingled vehicles. So, I'm not buying the munis myself, but Vanguard's buying them for me.
Yeah,
They can get caught in that.
exactly. Yes.
Great. And so then you said 529s fit into this somehow?
Yeah, I think 529s are an interesting vehicle. And when we talk about investment management and financial planning, a lot of financial planning topics get pretty narrow and deep and are kind of their own topic and don't have too much to do with investing. 529s, I feel like, cover planning, investing. It covers a lot, and it's a tool that can be used for a wide audience as well. So with 529s, it's a tax exempt structure if you use the funds for education expenses. And with that, there's two ways to invest in 529s, kind of two philosophical mindsets. One is you can do the kind of target date where you fund it and you want it to pay for someone's education and end at zero, and it's kind of an isolated asset. Or another mentality is to view it as an integrated part of your portfolio. In doing so, because it's tax exempt, that can lead you to put your foot on the equity pedal a little heavier to really get the most out of the structure. So that's something to think about. How do you want to use it? And with that comes a range of outcomes. Like if it's overfunded, what do you do? And there's next generation planning. There's other siblings, relatives, things you can do. And then also with 529, so I've found it to be an effective tool when talking with clients who have adult children. And sometimes you find that grandparents like their grandkids better than their kids, and maybe they have enough wealth and they want to do something. And it seems like it's a really sweet spot where you fund the grandchild's education, you make a contribution to the grandchild's education. You're helping your kids, you're also helping your grandkids, and it's also a good estate planning tool because it gets assets out of the estate, the taxable estate, while you still have some control over it. So just encourage people to talk to their wealth manager about 529 plans, really wherever you are in life. It can be a good tool for a multitude of purposes.
Great. Awesome. Thank you for that recap. Asset location 529s. And we could have started the podcast with this next topic, which we're going to use to wrap it up. But the market hit an all-time high in January. The S&P hit an all-time high at 4839, passing the previous high water mark of 4818 set on January 4th. So for those of you kind of keeping track at home, the last bull market peaked January 4th, 2022. The bear market that started that day ended October 12th, basically 9 months later, 2022. And, we hit a new all-time high in mid-January. Global markets have followed a similar pattern, but I think international stocks are a few percentage points still below their all-time high, but the same kind of general trajectory. So, Bob, when we're at all-time highs compared to, in the depths of a bear market or a recovery like we were the last 2 years, how does your advice for investors change?
It doesn't, in short. If you expect markets to go up over time, which we do, but we know the path isn't linear, but you should be at an all-time high a decent percentage of times. If you're kind of climbing up the mountain, as markets tend to do. So stocks do have a positive expected return, and we've tried to test markets based on total return, price return, and see if there's any future indication based on how you've done recently. And on the upside, there really isn't. Like if you say markets are up 10% to start the year, if they're up 20% to start the year, what does that mean about the future? And it really all comes out to it's about average. The only outlier in the data that we've found is if there's a big drawdown, you get a slightly above average return. So that's where if stocks are down 20%, we're looking to buy. But otherwise, our advice doesn't really change. It's more just discipline, have your right allocation. Don't get too greedy. Don't get over your skis.
Right.
But it's at an all-time high is not a signal to sell on its own.
That's an important point. In the work that you've done to maybe make tactical portfolio shifts, looking at, are there buying opportunities when markets are down, and are there selling signals when markets have done really well? You found there's basically no selling signal when markets have done really well. But yeah, you got a big enough drawdown. It is an attractive either rebalancing point or opportunity to add to your allocation. So that kind of drives what you just said in terms of, that there's no change to the advice when markets are at all-time highs. Just piggybacking off of that, because you talked about, markets should be near their all-time highs quite often. I shared in a blog post last week, the market spends more than half of its time within 10% of its all-time high, right? So people who will ask, I don't know, is it too late to get in? The market's doing really well. It's really near its all-time high, or it's at its all-time high. Well, it spends more than half its time within spitting distance of its all-time high because it trends upwards, fortunately. The other thing is bull markets last a long time. Since World War II, the average bull market has lasted over 1,700 days. Right. So I don't need to do the math in my head. Don't make fun of me, but I think that's about 5 years. But hopefully I got close to that. And, the returns are powerful. The average bull market return since World War II is over 150%. So most of the time, the market is in its upward trend, its upward trajectory. So just because, we get banner headlines at new all-time high, you didn't necessarily miss something, and you definitely don't need to revisit your investment strategy or approach.
Completely agree.
Thank you, Bob. It would have been awkward if you disagreed. But what else? Anything else on your mind? What you talking to your team about?
No, we just got through doing a lot of rebalancing. In short, we over the last 6 months or so, we've been adding to fixed income in light of higher yields. So seeing that our fixed income allocation is pretty strong and high quality in emerging markets.
Bob, can I interrupt you there? When you say adding to fixed income, that was a kind of a minor addition, right? I mean, it's not like we were taking clients from 65 to 60 in stock and 30, to whatever. You know what I mean? It is an incremental adjustment, right?
I think over the last 12 months, it was about a 5% move in total, and we've done it in multiple steps. So it does depend on the objective type, but roughly 5% has been moved over the last 12 months in multiple steps for most people.
And so, was it coming equally from across the globe in stocks, or was there a segment of the investment universe that it came from primarily?
For the average client, about half from real assets and inflation sensitive assets that were there to protect from the inflationary episodes we had in the last couple of years, and the other 2 or 3% from stocks.
From stocks, sorry. All right, so sorry I interrupted you. Please finish up.
Yeah, so increasing fixed income, and then within, this is a little more precise, maybe within emerging markets, we had a value overweight, and that's paid off for the last 3 years. Emerging market value did a lot better than emerging market growth. So we've been underweight China tech in particular, which has been a real sore spot for markets, but we've outperformed within emerging markets because of that underweight, and we pretty much closed that underweight. It's been so weak that we said, you know what, now let's take that underweight off, and we're more balanced between value and growth within emerging markets. The opposite has been true in the U.S., where, as I was saying, in emerging markets, value has done better than growth. In the U.S., growth has done better than value. So in the U.S., we like value, but it's just specific to emerging markets that we have about a 50-50 balance now.
Right. Okay. Well, I appreciate that recap, Bob. And as always, I think it's an amazing opportunity for our listeners to plug into your brain as you're thinking day in and day out about the investment universe and trying to translate that into good results. So thank you for sharing your insights today.
Thank you, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamas.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.